So I'm going to start us off. My name is Mike Tucci. I'm the CEO and co-founder of Lexington Wealth Management. We are a high tower company, and we've been part of that group since 2019, and we're having a lot of fun here. With that, we do these webinars with a whole bunch of different people with different expertise, and it's been a lot of fun over time. Today, we're joined by Mike Townsend. You've got a long title, Mike. Managing Director of Legislative and Regulatory Affairs with Charles Schwab. That's a mouthful,
It
right?
is.
Um, I'm just hoping, well, first I'll start off with, we're going to spend about 45 minutes today talking through some slides and going through some things. I'll probably interrupt Mike a few times with a few questions I've received already along the way. Anyone that would like to ask a question on your Zoom, there's a chat feature. You can ask a question. I'll see if it's covered. I may bring it up. I may not, because I've got a bunch of other questions here already. So we'll get started. Before we get started, Mike, I've been following your work for a number of years as a wealth advisor here at Lexington Wealth, and you and people like Liz Ann Saunders, you folks are very generous with your time, and you give us lots of updates on markets, the U.S., international, fixed income, and you cover policy. So I've really enjoyed listening to you over the years. And prior to the call, we did a first pre-Zoom call, and it was really a pleasure chatting with you and getting to know you a little bit. I was just hoping, Lexington, I tend to make everything personal, so I really like to know, like our clients and folks we work with, just to know the people we're working with. Can you give us a little bit of your background, actually where you started from in life, where you are now in DC, and what your role is at Schwab?
Yeah, sure thing. Well, thanks, Mike. And hi, everybody from downtown Washington. It is great to be with you. My name is Mike Townsend, and I have been at Charles Schwab for a little over 25 years, which is kind of crazy to say out loud. But I started my career in Washington working for two U.S. senators from Maine, Bill Cohen back in the 90s, and then Susan Collins, who's still there as a senator. And worked for a PR firm here in Washington for a few years. And then I actually just got hired by Schwab. I wrote a proposal for them, and they just came around the back and hired me. And I'm part of a little team here in Washington. There's five of us. We watch everything that's going on Capitol Hill, everything that's happening at the regulatory agencies, the SEC, the Fed, everything that's going on at the White House, and really try to figure out what it means for the markets. I like to think of my job as kind of helping investors cut through all the noise and the nonsense from Washington and kind of hone in on what's really worth paying attention to. And sometimes there's a lot more noise and nonsense than there is stuff worth paying attention to. But I think we're in a time right now where there's a lot worth paying attention to, and I'm psyched to have the opportunity to talk to everybody today about what we're watching.
Thanks very much, Mike. And when we chatted the other day, I instantly liked you. I wasn't quite sure why, but I later found out you were from Maine, and I spent a lot of my free time up in the coast of Maine, not too far from where you grew up. So I think that connection must have come through somehow. I'm going to lay out a little bit of our agenda today. We're going to talk about just the lay of the land right now, the Federal Reserve. By the way, happy Fed Day. We're waiting to hear from which way the Fed's moving in the next few minutes. So I'm sure Mike will talk about that. We're going to talk about what's the one big beautiful bill. It's going to talk about taxes, the debt ceiling, and more. We're going to talk about tariffs and market reactions, cryptocurrency, the Genius Act, the Clarity Act, government shutdown, market risk, and just market and political scene in general. So I'm going to start off with this, Mike. Mark Twain is attributed to this quote of history doesn't repeat, but it rhymes. I don't think he actually said it, but everyone says he said it, so we're going to say he did. Are we in that situation right now? Is this rhyming with anything you've seen in your 25 years?
Yeah, it's an interesting question, Mike, because I would actually say we're in a pretty unique time. Over the course of my time, I found that while politics can be an incredibly all-encompassing thing, its actual impact on the markets typically is relatively small, except for a few big things that happen. Obviously, the Fed we'll talk about and other things. But we've been in a period over the last 6 or 8 months since the beginning of this administration where it feels like everything that's going on in Washington kind of applies to the markets, whether that's tariffs, whether it's taxes, obviously Fed policy and other issues. So it seems a little more right now that there's more of a connection between Washington and what's happening in the markets than usual, but we'll see. It's a unique time, I think.
It's been an exciting year to say the least. So why don't you jump into um, the slides and let's start a conversation and walk us through it. There's certainly been a lot going on.
Yeah, sounds good. Well, thanks very much. Let me go ahead and share my screen and I get my slides up here. Do, do, and start those. Okay. Hopefully you can see those okay. Well, thanks very much, Mike. I thought I'd just start with a quick lay of the land. I think everyone knows that we are in an all-Republican Washington right now, 53-47 for the Republicans in the Senate. As of today, it's 219 to 213 in the House of Representatives. There have been 3 deaths in the House of Representatives. 3 Democratic congressmen passed away earlier this year. There was a special election just a week or so ago, so there's a brand new member of Congress from Virginia. And then there's a special election next week and another one in November to fill those Democrat seats. And then there's a Republican special election for a vacancy that'll happen in December. So when it all shakes out, probably by the end of the year, we'll be back at 220 to 215 for the Republicans. Historically, that's an incredibly narrow margin, and we'll talk a little bit as I go along about how that's made it really, really difficult to get things through Congress in an easy fashion because of that really narrow margin. Generally here in Washington, Mike, you and I talked about this a little bit in our call earlier this week. It's a really unusual atmosphere. I mean, Washington has been kind of reeling from the DOGE cuts to the federal workforce. Right now, we have military law enforcement presence here, so there's literally like tanks outside the baseball stadium and that sort of thing as part of the president's crime fighting initiative. And then there's just this kind of endless string of court cases. It seems like almost every day, everything is being challenged. And we're getting rulings from courts and appeals courts and even the Supreme Court with regularity. So every day feels kind of chaotic here in Washington. But what I'm going to try to do today is kind of cut through a little bit of the chaos and focus on the things that really matter. And obviously, the starting place today is the Fed. So I can break
Hey, Mike,
news while we're sitting
pause for
here.
1 sec. Are Doge cuts still happening?
DOGE cuts are not really happening. So DOGE, the Department of Government Efficiency, was the Elon Musk led effort at the beginning of the year to kind of go through each department and cut down the workforce. That happened. There was a lot of sort of buyouts and that kind of thing for federal employees. We also saw, entire agencies like the U.S. Agency for International Development, USAID, and the Consumer Financial Protection Bureau that have been, basically like emptied of employees, though they still kind of literally open. But the pace of that has really, really slowed down. There are some things going on still across some of the agencies where there are kind of voluntary early retirement programs that are pretty generous right now and that kind of thing to try to continue to whittle it down, but nothing like the first couple months of the year.
Thank you, Mike.
Yeah. So as I said, we can break a little news here on this webinar that the Fed has just come out with a 25 basis point cut. Not at all a big surprise. And that, of course, is the first rate cut of the year after ending last year with 3 straight rate cuts at the end of 2024. As I said, not a surprise. Jerome Powell had signaled that this was coming a few weeks ago at the Fed's annual gathering in Jackson Hole, Wyoming. I think there continues to be a lot of concern around the sort of directional trends of jobs, which are softening a bit, and inflation, which is rising a bit, but not maybe as much as a lot of people feared earlier this year. I think the interesting thing is going to be where does the Fed go from here? We've got a couple more meetings here at the end of the year. The market's starting to trend towards 2 more rate cuts before the end of the year. I think, we're in that kind of 1 to 2 phase now that there's been a rate cut today. And one notable thing, it does appear there was 1 dissent in favor of a 50 basis point cut today. But there was a lot of speculation that there may be more interest in a 50 basis point cut today. It sounds like that is not what materialized. The really almost it feels like the monetary policy decision is almost like the sidelight to the real drama going on at the Fed, which is around personnel, because of course the president has taken the unprecedented move of attempting to fire a sitting Fed governor, Lisa Cook, who has been a governor since 2022. The president is attempting to fire her for alleged mortgage fraud. A lower court ruled that she could stay on the job while things play out. The appeals court ruled on Monday to uphold that and continue to let her serve while the case plays out. I do assume that that case will end up at the Supreme Court at some point. But it's going to be interesting to see what the Supreme Court does, because earlier this year, in a case unrelated to the Fed, but related to the idea of the president being able to fire the heads of independent agencies, this was one that dealt with the National Labor Relations Board. The Supreme Court kind of went out of its way to acknowledge that the Fed is a bit of a unique entity, calling it a uniquely structured quasi-private entity, and sort of indicating that was not the same as other independent agencies. And I think that's going to be interesting if and when this case gets to the Supreme Court. I think the court is going to have to wrestle with whether the Fed is a unique entity. I think there is a lot of concern among economists and other market analysts about chipping away at Fed independence. And that was exacerbated by the unexpected resignation in August of one of the 7 Fed governors. Adriana Kugler stepped down, and the president appointed nominated Stephen Miron, who is currently the chair of the White House Council of Economic Advisors, to fill in the remainder of that term. Now, notably, that term only runs until the end of January 2026, so basically 4 months. But Myron, who was confirmed literally on Monday and sworn in and just like walked into the meeting that started yesterday at the Fed, I would have loved to be a fly on the wall for the dynamics in the room around all of that. But he has somewhat controversially chosen not to resign from his White House post. He's taking an unpaid leave of absence, but he's technically still a White House employee and a Fed governor, which is an unprecedented situation that has raised a lot of questions about independence. The third sort of piece of all this, of course, is that Jerome Powell's term as chair ends next May. And the White House has sort of undertaken kind of a very public sort of process of interviewing different candidates, former Fed governors, current Fed governors like Christopher Waller, who is currently on the board, is a candidate, outside people not in the government, people from financial services firms and such. And that process is ongoing. Scott Bessent, the Treasury Secretary, is in the process of interviewing people. I think it'll probably be another number of months before we get an announcement as to who would potentially be the nominee to replace Powell as chair when his term ends next year. So just a lot of unusual movement here.
Yeah, I agree. A question on that: when Powell's term ends, let's hope he stays through the end. At least the market, I think, hopes that's what happens. Does he have the possibility to stay on the board, but just not as chair?
Yeah, one of the unusual things here is that his term as chair ends in May of 26, but his term as a governor doesn't end until 2028. Now, it would be historically unusual for the chair to sort of step down as chair and stay on as a regular governor, but that is one of his options, and there would be nothing wrong with doing that. He has pretty pointedly not said what he plans to do, and I don't think sees any reason to reveal his plans anytime soon. But that's a little bit of the reason why there's a lot of this kind of behind the scenes maneuvering going on, because it's not clear whether there will be a vacancy when he leaves as chair, because he doesn't have to leave as a governor. So interesting situation to watch.
In that regard, it's said, interest rates are always top of mind when it comes to looking at the Fed. But in terms of depending on who makes up the Federal Reserve, that may have implications with respect to policy and deregulation in particular. Any thoughts on that?
Yeah, I think there's no question that, look, this administration is really pro deregulation. I mean, there's an executive order the president signed back in January that basically says that any new regulation, you have to get rid of 10 regulations before you can put that new regulation into place. So I think the Fed, which is that's its other role, is sort of the regulator of the largest banks in the country, is looking at ways to sort of ease back some of that regulation, and not in I don't think a huge slash and dramatic way. But there are a number of proposals that were being worked through the Fed in the last administration around how much capital banks had to hold and that sort of thing that I think are being re-looked at. So that's the sort of I think quieter part of the Fed's job. The headlines are all about monetary policy, but I think we're going to see in the next 6 months or so, more clarity coming from the Fed in terms of how it wants to regulate big banks going forward. So that's another thing that we're going to be watching carefully.
Interesting. Thank you.
Yeah. I'll jump to some of the things going on Capitol Hill, and we'll start with taxes and the so-called One Big Beautiful Bill. I think as the bill now is the law of the land, a few things to kind of keep in mind. The whole reason that this bill exists is because the 2017 tax cuts that were a hallmark of the first year of the first Trump presidency, all of those were set to expire at the end of this year. So even back a few years ago, we knew 2025 was going to be a big tax year because we knew it was going to be difficult to let all those tax cuts expire. And that's exactly how things played out. The heart of that 2017 bill was lower individual income tax rates. The new law passed in July, signed into law on July 4th, now makes those permanent. So the lower individual income tax rates are here to stay. It also makes permanent an increased standard deduction and a slightly increased child tax credit. And really, from a planning standpoint, I think probably one of the most important aspects of this bill is that the estate tax rises to $15 million per person, $30 million for couples, beginning next year, and will be indexed to inflation after that. So typically it'll go up a little bit each year. And that is the amount of assets that can be inherited without triggering the estate tax. So having certainty on that I think is really important for planning standpoint. Certainly, Mike, I'm sure from your perspective, that's a key one to as you think about estate plans and long-term plans for clients. I think that's an important one to have clarity on.
That was for a lot of our clients a very big win in terms of knowing the certainty around it and the dollar figure. And of
Yeah.
course, different states have different rules. Mass is not a great place to die in from estate tax perspective, and there's several other states.
Yeah.
One other comment I'd like to make here is there's a lot of, as you made a point in the slide, there's a lot of income caps and restrictions on all of the above, and even the state and local income tax deduction of $40,000 that fades away after about $500,000 of earnings. And I know a number of these, I've saw an analysis from Morgan Stanley, and they pretty much think that this big, beautiful bill could add a fair amount to GDP over the next several years. But in their opinion, it will most likely reverse later this decade in 29 as a lot of the items phase out for individuals and more of the cuts take place.
Yeah, I think it's going to be interesting to see. And one of the things I'd highlight is, you had these campaign proposals from the 2024 campaign that the president really pushed for and ended up as part of the bill. The no taxes on tip income, no taxes on overtime hours, interest on auto loans being tax deductible. And the other one the president had talked about on the campaign was no taxes on Social Security benefits.
Mm-hmm.
Well, it turns out that the parliamentary process by which this bill was considered, you can't do anything to Social Security. So what they did instead was add this special $6,000 tax deduction for seniors 65 and up, again, subject to income caps and other restrictions. But they did that to try to kind of balance out that idea that they couldn't make Social Security benefits tax-free. But what I think is really notable about these, as you mentioned, these all expire in 4 years at 2028. What's 2028? It's a presidential election year. As I look at my crystal ball going forward, I'm wondering, how is Congress going to let these expire in a presidential election year? And I'm guessing that no taxes on tip income and things like that are going to be pretty popular and pretty hard to get rid of. So even though these have a sort of sunset to them, it's going to be interesting to see whether Congress actually ends up extending them as part of that kind of election year debate in 2028. And the other one you mentioned, of course, was the state and local tax deduction, which was a very odd political issue in Washington. It was really driven by about a half dozen members of Congress, Republicans who represent high tax places like New York City, Jersey, Southern California. And it was kind of a red line for them. That cap that had dropped to $10,000, they wanted to get that up. The political problem was, your average member from Oklahoma doesn't care about this at all.
Mhm.
It's not, something that they feel strongly about. So this kind of small but vocal group really had to work hard to get anything in the bill. They did get an increase to $40,000. As you mentioned, it has a $500,000 cap, at which point, income cap, at which point it starts to phase out. So, as I look ahead at some of the other tax things, we also have some notable things in the charitable and nonprofit sector. Of course, increases taxes on university endowments, but exempts smaller colleges. But one notable one, I think, is the new $1,000 charitable deduction for non-itemizers. It actually harkens back to something that happened during the COVID period when there was for a couple of years, there was a small tax deduction for people to give to charity who don't itemize their taxes. Now that's a permanent part of the tax code. So if you don't itemize, you can get that charitable deduction. And then one that I don't think has gotten much attention, there's a new floor for charitable contributions for people who do itemize that basically disallows a deduction for the first little bit of your contributions. It's up to 0.5% of income. So simple example, if you earn $100,000 a year, the first $500 that you give to charity can't be counted as a charitable tax deduction. So that's a big change that I think will surprise people who haven't been kind of following this when it comes to doing their taxes in future years. Also, the other thing that's notable, a lot of the green energy tax credits from the Biden administration are ending. If you're going to buy an electric vehicle, you got about 2 weeks before that tax credit goes away. The one for energy efficient home improvements ends at the end of the year, and there's lots of others that are going away from as a result of this bill. And then
Can you skip that
finally,
last one on the page, Mike? The 5 trillion increase in debt ceiling.
yeah, and when you were talking about the potential for economic growth out of this bill, I think part of the challenge is sort of weighing the economic growth benefits versus the debt and deficit problem, because this new law increases the debt ceiling by $5 trillion, so that's the maximum amount of debt that the United States can accumulate. We'll take that north of 42 or so trillion dollars in the future. And, the debt ceiling battles are really controversial. They tend to upset the markets and spark volatility when we have them. So in the sense that it takes the issue off the table until well after, I think, the midterm elections, well after a new Congress is seated in 2027, it doesn't address the sort of big underlying question about the debt. And one of my kind of big takeaways from this bill is nobody really cares about the debt and deficit
Mhm.
anymore. The bill is projected to increase the debt by somewhere between $3 and $3.5 trillion over the next decade, and everybody voted for it. There were Republicans who, prior to this year, had never voted for a debt ceiling increase, who voted for it this time. So I do think that's notable. I think we've seen a little bit of unease, I think, in the bond market around debt and deficits and the concern, the directional trend that we're going. And I think as this law plays out over the coming years, I think that's going to be a key aspect to watch.
Hey,
Just a
Mike,
couple of
one quick
other, yeah,
question on that, and we'll get to tariffs next.
yeah.
But I've seen estimates, depending on whose estimates you look at. If the tariffs stick, they're projected to bring in between 2.2 and 2.8 trillion over the next 10 years. If they do stick, is that an offset to this, or will that money just get spent?
So yes, in that way that like, big numbers sort of offset each other in the government, but how that money is directed, I think is the question because it doesn't appear likely that tariff revenue is going to go sort of directly to reducing the budget deficit, for example. Just the way the government works, right? It kind of goes in one pocket and out the other. And I think there's a concern there that that revenue won't sort of go to reducing the budget deficit. So we'll have to see over time. I will say, just a couple of other takeaways. As you mentioned earlier, I do think it creates some certainty on taxes. And then, this is going to be a big messaging battle going forward. And I think this is going to be the big issue in the 2026 midterms is around whether this works as an economic policy. There's lots of other stuff in this big, giant bill that Democrats feel like they can really push on Republicans for cuts to Medicaid and cuts to food stamps and the imbalance of the tax cuts towards wealthier filers and away from less wealthy filers. I think Republicans have struggled so far to educate voters about kind of what's in the bill and make that argument about the potential economic growth from it. And to me, that's really where the battle is going to be drawn over the next 12, 14 months until next year's midterm. So
I
we'll
agree.
watch. Yeah.
I have something a note here on the side. We didn't talk about this, but what wasn't included in this bill, and the three things that caught my eye was I think the municipal bonds are exempt from federal taxes, and that was a question: will they suddenly be taxable? And I know the municipal market was a little shaken up by that this spring, right?
Yeah,
Um,
I just on the Muni one, I would just say that kind of gets talked about every time there's a big tax bill up, and there is sort of a little flurry of concern. But cities are really good at sort of articulating to their member of Congress, like, hey, that would not be good for us, and I think it ended up not moving very far along.
saw that. And carried interest. Can you quickly describe what it is and talk about
Yeah,
the
carried interest is, another one of these things that seems to come up every time and really has to do with how, sort of private equity and different types of business structures use as kind of pass through and all this kind of thing. Um, I think there's been a lot of talk about changing the rules there, and I think that's still on the table, but no big changes here in this bill.
Okay, great, great.
I wanted to just switch gears briefly to tariffs. I think everybody is aware of how many different tariffs we have going on out there. We have the sort of country by country tariffs, the so-called reciprocal tariffs. We have the tariffs on China and imports from Canada and imports from Mexico. We have product-specific tariffs right now on things like steel, aluminum, copper, cars, and car parts. Semiconductors and pharmaceuticals likely to be next. But to me, the real sort of thing to be watching, and the market I think is watching, is the court case around this. Uh, the U.S. Court of International Trade back in May ruled that most of the president's tariffs were unconstitutional. That the mechanism that he was using, which is an emergency authority, was not intended to be used for tariffs. Court of Appeals immediately paused any change to the tariffs while it considered the appeal. That appeals court then upheld that ruling late in August, but they kept the tariffs in place through October 14th while the administration appeals to the Supreme Court. And while the administration has asked for a quick decision from the Supreme Court, quick and Supreme Court are not typically two things that are used in the same sentence. Even the arguments around this case before the Supreme Court are looking like they're going to happen in early November, which is, of course, after that October 14th date. So it's not totally clear what's going to happen to the tariffs on October 14th, whether they'll be suspended. Potentially, if the court rules against the administration, you might have to see refunds paid to companies that paid tariffs. So there's a lot of uncertainty here that results from this situation. We're going to have to wait for the Supreme Court to hear the case and decide the case. I will say the administration does have other avenues available to it to impose tariffs. This is a fight about this specific authority that the president used to impose the reciprocal tariffs and some of the other tariffs, not about sort of whether tariffs are a good thing or a bad thing. It's just about the mechanism. And the
Mhm.
administration does have some other temporary ways to do things. But if the Supreme Court rules against the president on this, I think that would be that would be a big deal for the market in terms of the reaction and trying to sort out, kind of where all the money that has been paid to date goes and that kind of thing.
Do you, maybe not your turf, but do you think that's a good reaction from the market's perspective or a bad one?
Well, I think it just highlights the sort of uncertainty that we have here. There's a lot of these issues right now are kind of hung up in this limbo state where when you take the Fed and who's serving on the Fed, you take tariffs, waiting for court decisions. And I think the market, generally right now is sort of putting that on the back burner, but is going to have to confront whatever the decision is. And so I think it just creates a little bit of an atmosphere of uncertainty for the fall that the market is going to have to process and figure out how to deal with. I did want to show this chart because I just think this is a really interesting chart about what a crazy year it has been in the market. So these are the four major indices. First column there is where we are as of Friday. This is the data I used from last week. Year to date, we're having a strong year to date. Noting that the Russell 2000 small cap index is starting to pick up. It had been lagging even more behind some of the other indices. It is trying to catch up. The second column there is the market return since the April 8th low. So that was right as the president was announcing the reciprocal tariffs. Market reacted really, really strongly to that. And obviously, we've had an enormous rebound since then. The third column is how much that index dropped going down towards from the high it was down towards that low on April 8th. But I think the last column is the interesting one because the last column looks at the individual members' average drawdown in these indices from that high and to that low in April. And you just see how much volatility there has been at the individual member level. And I think that a little bit speaks to the uncertainty that's kind of hung over things based on tariffs and the disproportionate way tariffs affect different types of companies have made it difficult for companies to plan and difficult for companies to provide guidance. And I think we're all aware of that kind of aspect of uncertainty. And I just thought it was interesting to kind of look at how the market's been thinking about tariffs over the course of this kind of funny roller coaster year.
I think one of the big surprises, Mike, I think to the market's been that we haven't seen inflation kick in more than it has. And I keep hearing from analysts on Wall Street, wait another quarter, wait another quarter, wait another quarter. And maybe that will be the case, but I'm just curious to see how it plays out.
Yeah, I agree with you, Mike. I think it has been a bit of a surprise that companies, and I have to remind people all the time, U.S. companies pay the bulk of the tariffs. The importing company pays the tariff. It's not the foreign country that pays the tariff. But so far, companies have not passed that on in the form of higher prices, I think, to the degree we thought. Now, we started to see in the most recent round of earnings more companies saying they're getting to the point where they may have to raise prices and they may have to raise prices. But because of some of the uncertainty about whether tariffs are going to stay in place, these companies, I think, are holding back on doing that. I also think the other thing is that there has been in the first half of the year, there was sort of a forward buying. A lot of companies really stocked up on supplies, knowing that tariffs were coming, and some of those supplies are starting to dwindle. But we'll see. I think that's one of the key questions for the remainder of the year is whether inflation, flattens out or continues to tick up.
Thank you.
I wanted to touch just very briefly on an issue that has become so interesting here in Washington. You really can't come up with an issue that has had more of a 180-degree turn than crypto in the last 9 months. Previous administration, very hostile to crypto. This administration, not so hostile to crypto. But particularly, it's been notable that there's just kind of a formalization of cryptocurrency and digital assets as part of the policy universe here. So there's now a presidential working group on digital asset markets. Both the House and the Senate now have subcommittees for the first time ever focusing on digital assets. The SEC has a working group on digital assets. We've got this executive order to create a strategic Bitcoin reserve, which is going to be, made up not of taxpayer purchased Bitcoin, but rather of mostly of seized Bitcoin from criminal cases and that sort of thing. And then we've had the first ever law pass earlier this year, the Genius Act to regulate stablecoins, which are a certain type of cryptocurrency that is pegged to the dollar. We have another piece of legislation moving right now. The House has passed the Clarity Act. The Senate is going to be taking it up this fall. That creates a sort of a larger market structure for crypto in general, beyond just stablecoins. And I think the idea here from the crypto industry, and I think from the investor perspective, is to create a regulatory structure that kind of puts some guardrails in place that clarifies who's in charge of overseeing this space. The proposed law would put most of that burden on the Commodity Futures Trading Commission, the CFTC. And we'll see how it all plays out, but I think the idea is to help give investors some confidence that there's kind of a watchdog on this relatively new kind of asset, and we'll see how that plays out. There's a little bit ways to go on the Senate on that legislation, but definitely something we're keeping track of.
Thank you.
And then finally, I wanted to just touch on an issue that's very time sensitive right now, and that is the risk of a potential government shutdown here at the end of the month. So quick refresher, Congress is supposed to pass every year the 12 appropriations bills that fund every government agency and every government program, and they're supposed to do that by October 1st because that's when the government's fiscal year begins. That hasn't happened. The fact that it hasn't happened is not in itself unusual. It almost never happens by the deadline. And usually what happens is Congress passes what's known as a continuing resolution, which is a temporary funding of the government for a period of weeks while negotiations continue to finalize all those spending bills. Congress is right up against the deadline here in 13 days. I think what the dynamic is Democrats are really concerned that if they agree to a bunch of compromises to fund the government, that Republicans will just turn around and claw back the funding they don't like. And the reason that they're worried about this is because earlier this summer, for the first time in about more than 25 years, Congress did pass what's known as a rescission bill, which is a bill that claws back funding that Congress itself has already appropriated. And this one clawed back about $7+ billion in foreign aid and about $1.1 billion in funding for the Corporation for Public Broadcasting, National Public Radio and Public Television. The trick here, the reason why this is such an odd dynamic, is that to pass an appropriations bill in the Senate to fund the government, you need 60 votes, a supermajority, which in today's Senate means you need at least 7 Democrats to join with the Republicans. But rescissions bills to cut funding only require 51 votes, a simple majority. So that's why Democrats are worried. We don't want to make a deal just so that they'll get our votes and then they turn around and undo the funding. So there's a lot of tension here around whether there's going to be a government shutdown. But the key question is, do government shutdowns matter to markets? This is a lot of information on this chart. What I want you to know is that lower right. That is the S&P 500, where that circle is. This is the S&P 500 reaction to government shutdowns. And I would note that the S&P 500 has actually gone up in the last 5 government shutdowns, which probably tells you all you need to know about the markets and what it thinks of the government. But so there's a little bit of a shrug, I guess, by the markets around government shutdowns. I think government shutdown at the end of this month is a 50-50 call right now. There is some concern that foreign investors and fixed income investors are growing more and more worried about the U.S.'s sort of ability to manage its fiscal affairs. I mean, I talked about the debt and the deficit earlier. Just funding the government is probably the most basic thing Congress is supposed to do. So the clock is running on this, and we'll see what happens. Mike, I want to just end with a couple of fun charts, and then we can talk a little bit more. This first one is just an interesting one. This is every election since 1960. And the ones in the yellow box are the ones in which at least one of the House, Senate, or White House changed in that election from one party to another. And what I want you to notice is that 1960 to 2000, we had 20 elections, and only 7 times did any one of the House, Senate, or White House flip parties. But in the 13 elections since 2000, 11 out of 13. So we are in an era where we just keep changing what the combination is. And it would not shock me at all in 2026 to see Democrats win the House of Representatives based on this historical trend, based on the narrow margin. They only need to win a few seats. And generally, presidents don't do well. The president's party doesn't do well in midterm elections. So we'll see. We'll see how that plays out. This next one goes to a question I get asked all the time. What's the best political configuration for the markets? We use the Dow Jones Industrial Average, goes back 120 plus years. And, interestingly, the best one for market performance has been the one that we just had, which was a Democratic president with a split Congress. But that's the rarest. So we have the least sample size for that. You see the red arrow there, that's where we are now, Republican president, Republican Congress, 7+% average in terms of the Dow Jones Industrial Average return. I get asked this question all this time, and I show this chart, and then I say, I'm not sure this chart is really of any meaning at all. The market doesn't, care that much about what's going on in Washington and who's in power. It cares about some issues, but we all know that the market cares much more about the economic situation, about company earnings, and that sort of thing. So, always fun to put up a chart and then say, yeah, don't pay attention to that chart. I do want you to pay attention to these last couple of charts, though, because these I think are really important in this time. This is just a visual depiction of the growth of a dollar since the early 1960s across every presidential administration. So red for Republican, blue for Democrat. And we all know there are ups and downs in the markets, but obviously that trend line is a really, really good trend line. This is the exact same chart. I just overlaid who was in charge of Congress, which party held Congress. So purple is when you had a split Congress. Red, you had an all-Republican Congress with a Republican president. Blue, you had an all-Democratic Congress with a Democratic president. Again, obviously the same trend line. But this is the one I think really brings that home. If you had invested $10,000 in the early 1960s and only kept it in the market when a Republican was in the White House, you'd have about $100,000 today. If you only kept in the market when a Democrat was in the White House, you'd have about $625,000 today. But if you kept it in the market the whole time, regardless of who was in the White House, of course, you'd do much better. You'd have about $6.4 million today. The reason I show this at the end of my presentations is because I understand that this is a really emotional time for people. You probably have really strong feelings about what's going on in the country, in Washington, whether you're happy, whether you're horrified, whether you're looking at property in Portugal. There's a wide range of emotions. And Mike, as you know as well as I do, those emotions are a terrible mix with your investing decisions. So I just want to caution people to not make financial decisions, investing decisions based on what's going on in Washington. Yes, Washington has an impact on the markets, but generally, those kind of emotion-driven decisions are really something to stay away from. So I'll stop my monologue there, Mike, and I know we can wrap up with a few thoughts from you.
My observation is over the last 10 years, it's gotten, if you're right of center, you're not happy when Democrats are in, and it can affect your investing. If you're left of center, the same thing is true. And I think it's somehow tied with social media, maybe cable news, not sure what it is, right? That said, your last few slides, I couldn't agree more. I will say that my biggest long-term concern is the U.S. debt. And particularly, probably, most economists I've talked to and chief strategists, they say, yeah, but not now. But if unchecked, it most likely will become a problem, whether that's in the 2030s or beyond. So I guess the government doesn't seem to be, neither side has really been all that concerned with it, it seems, or they played lip service to it. So that's my biggest, from a CEO of a wealth advisory firm, when I'm looking at the tea leaves and looking at longer term, that's probably my biggest concern.
Yeah, Mike, I'll just add to that. I 100% agree with you. And I would just say this. I think one of the challenges around the debt is when you talk to ordinary people about a debt that's, somewhere approaching $40 trillion, it just sounds like a made up nonsense number. It doesn't really, a lot of people don't really think about how that affects them. It just sounds like, made up money. And I think that's where we're all trying to do more education on why you should care about this, frankly, and why you should tell your member of Congress to care about it. Because for years and years, I've been in Washington for 30 plus years. Everyone was worried about the debt getting to this level or that level, and now it just seems the number is so high that it's almost kind of hard to comprehend. And no one seems that aggravated about it, which I think is going to come back to haunt us at some point. And I'm hopeful that Congress will get the message sometime soon and start to
Well,
try to get that
the only
down.
thing I've heard is somewhat optimistic from a major Wall Street firm is we'll grow our way out of it, right?
Yeah,
And I hope that person is correct.
yeah, absolutely.
But this has been super informative, Mike. I really appreciate on behalf of our clients. If no one heard a word I said, it almost doesn't matter. Hearing what you had to say was much more important. So we're very thankful for you today, and really appreciate you. So
Thank you. Thanks, everybody.
thanks. Have a great day.